Today, more from the Property Frontline. Hello, I'm Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I'm joined again by Chris Bates. Hello, Chris. Good to see you again.
Hey, Martin. Good to see you again.
You just couldn't stay away, could you? It's good to see you back.
Thanks for the invite.
So we had a really good conversation last time about your role as both a financial advisor and a mortgage broker. And we started to touch on a really interesting subject, which was the different types of property and the different developments in different places that are going across the market in Sydney and perhaps in Melbourne. And I felt that we could probably have taken that conversation quite a lot further. So that's what I'd like to do today in terms of it isn't one market, is it? It's multiple markets.
No, and I mean, this is one of the biggest mistakes people in property kind of fall for. It's easier to think that it's just one big market and the market all goes up together and it all goes down together. And every property is going up at the same rate and every property is falling at the same rate. Much simpler for us to think like that. It's much simpler for the media to report like that. But really, you never buy the market. You know, there's not an index to the Australian property market that we buy. We buy one property, or we might buy 6 properties, which we can get into as well. But that is really what matters, what happens to your property or the property that you're trying to buy. That's what you really care about. And that could be completely different to, you know, the other 9 or 10 million properties that are out there.
So what that says is that these top level property movement indices, like the CoreLogic one, it gives you some information, but actually it doesn't necessarily give you a huge amount of information because, as you say, it's your individual property, and that may be behaving quite differently from what the average of multiple properties in multiple locations might be.
Yeah, exactly right. So I mean, it's great to hear that the Sydney market's going down 7%, but you know, that's very pointless statistic, really. I mean, it only really matters for a headline. What then matters, though, is for people who own property or people who are looking to buy property is what's happening to those properties, you know, that affect them. And that could be very different to 7% down. It could actually be up. I mean, the biggest mistake people first make is they don't differentiate between units and houses. The people who buy units are completely different to the people who buy houses. And you know, in an area, housing market could be going up and the unit market could be going down. So you really have to kind of keep going deeper and deeper and deeper to really understand the micro market, because that's what you actually buy with property. You actually don't buy, you know, the market.
And I guess to an extent, the price is the end of the process, not the start of the process. So if you decide to buy something, you've got some view as to what you can afford, but then you start looking at the particular location, the particular characteristics of the location, the type of properties that are there, what you want, and you go through that and eventually end up with hopefully finding something that fits within the budget that you have. So actually starting from just, well, the prices have gone up 5% or down 7% is actually perhaps the wrong end of the stick anyway.
Yeah, I mean, you're right. Like, I think that, you know, people naturally go, oh, the market's going down, or, you know, and if it really, once you then go and look inside a suburb, you could find that the story is completely different. And so what you've always got to do is just keep on kind of cutting it down, actually go into the micro markets, and that's what you should be focusing on, and not fall for the headline kind of story.
So if we take Sydney as an example, are there particular areas in Sydney where you're seeing different behaviours, say, from last year? And is it different from properties that are units compared with houses?
Yeah, so every market will be behaving differently. You know, what's happening in, say, Stanmore versus Petersham or Lewisham, you know, they've actually got, the markets will be, even though they're so close to each other, they'll actually be behaving differently. And if you keep on expanding that, what's happening in the northern beaches to the eastern beaches to Penrith to the Blue Mountains, they'll always be behaving differently. And so in the booms, they'll always be going up at different rates and going down at different rates. So, I mean, that's just generally, it's always going to be like that. From the different types of assets, though, 100%, you've got different buyers as well. So, you know, a unit or a one-bedroom studio is only going to, you know, basically tailor to a single, really. Maybe a couple could pull it off till they kind of kill each other. But mainly, you know, 90% of those, maybe even more, are bought by investors. So studio apartments are going to have a If the investor market's buying, then they're going to go up. If the investor market's selling, then they're going to be going down. Very few homeowners are in them. But if you go one-bedroom units, then they're going to behave a bit differently. You maybe got couples that will consider it. And then when you go to, two-bedroom units, maybe it's a couple with one kid or a downsizer or a divorcee. And then you go to three-bedroom units. And, the story just keeps changing because your demographic and your markets, keep changing as well. Generally speaking, it's pretty crazy. In Victoria, about 60% of the stock of apartments and units are owned by investors. And, in some suburbs, it's a lot higher than that. So if you look at, areas where there's lots of high rises, it could be 70, 80 or 90% of the property are bought by investors. And that means there's very few people that are buying there to live. They're actually all the people who own the property are all investors. But then you've also got some areas where the apartments are mainly and units are mainly owned by owner occupiers. They could be kind of in low kind of density, low height kind of suburbs that are more community-like. You could find that 60, 70, 80% are actually homeowners. So it's really understanding the micro markets, and they're always going to behave differently. The big thing that's happening now, though, is in the last 4 years is everyone knows the property market was getting out of control. Everyone was pushing out a lot of first home buyers, upsetting a lot of people who want to upgrade. People who are just out of the market, rents are going to be having to go up to compensate investors, and it's upsetting a lot of people. So what the government did is they really just targeted investors, and they just went, what's the best way to attack investors is to cut their borrowing capacity, and they've done that. It's without doubt that's been very successful, and that has cut back the investor loans, and also obviously the interest only, which is getting talked about obviously so much, putting a focus on banks to not allow investors just to gear up basically to the nth degree without paying any capital off. That's really been targeted as well. So that's been very successful. And that's obviously cutting, a lot of demand for investor type housing.
Yeah, we've certainly seen. It was interesting. The APRA stats came out today. That's the quarterly property exposure stats to June, and there was a slight uptick in the volume of investment property this quarter compared with last quarter. I guess that may be because effectively a couple of the lenders got a free pass to lend a little more. But the other interesting observation was that the proportion that are now made outside standard serviceability requirements is up to a 6% for the major banks, which is higher than it's ever been, which is really interesting.
Yeah, it's pretty worrying. I think that should be if I was APRA, every single exception should be looked at and carefully looked at. And everyone should be playing the same game, So, if some people are getting through the system for some reason, that's not good news. I think that's pretty poor. And I think that's what, if I was APRA, that's exactly what I'd be looking at.
And the overall growth was still 7%. So, it's not like the whole market is dying. It's just, it's quite interesting. So I had one specific question. If somebody comes to you and said, look, I'm thinking of buying a property, right? What are the top 3 questions that you don't want to ask them in terms of trying to help them and steer them towards the right outcomes? Yeah,
so it's actually interesting. I quite regularly that now it's actually clients are deciding to wait, because the benefit of waiting is that we don't know where things are going, and even if they're buying a home, if in their situation they're probably stretching or they haven't got the savings, they're still building up the savings, and it's probably a pretty good gamble that even if you want a good asset, potentially in 12 months' time you could probably get it at a better price or actually get into a better suburb for the same price. And so it's not such a sure. When the market was booming, you felt like if you weren't in the market you were going to lose out. That's definitely not there. So that pressure to just get something is definitely gone. And I think that was a crazy pressure anyway, because it just forces you to make a poor decision. But the questions I ask, firstly, it's really just understanding their life, where they are with, their family and work and, their parents and where they want to live long term, and really trying to understand. I always try to break it down. What's their lifestyle goals, but where they want to live long term? Let's make sure we understand that, and that might be renting, but let's even talk that through long term as your family progresses and you get older. Is that something you want to do? But if you want to own a home, let's try to solve that now. And so let's try to come up with a solution for that. So a lot of my clients who are coming to me first, we're trying to figure out how do we actually solve that problem, and that might be buying their future home as an investment property now, and renting it out for 5-10 years till they actually need it. And so that's probably one thing, is really understanding their life. Really their savings and their capacity and their stability with work is probably the next thing. I don't think it's a great time to be kind of borrowing no clients really ever borrow more than 90%, but even if you can get up to 88% and have no buffers, it wouldn't take much for things to just get too tight. So I think now's not a time to be gearing and just hoping for the best. So that's probably the second thing. I mean, the third thing's probably more just understanding where they're at with their current assets as well. I'm finding that's becoming a bigger and bigger problem. And so before we even go forward, we're always looking at what they currently own, and do you have great properties? Are they, something that you should reconsider? Should you speak to someone else about maybe getting rid of them? And so that's probably, the other big question is, do we have assets that we need to get rid of?
And what about the question of expenses, the reality of the tighter lending standards now? I mean, banks are asking for much more information. They're looking for these multiple categories. Are you finding that some of the potential buyers are struggling with jumping over those hurdles, or what's happening with those new rules?
Yeah, 100%. I mean, that's always been the elephant in the room with bank lending has been expenses. I mean, loans are always lodged, through the branches, through brokers all over the country. And when the bank would look at the file, the minimum living expenses was used, or something close to the minimum living expenses. Those days are gone. Every single file, every single bank statement. I just jumped off the call then, and a client the bank had picked up there was a credit card payment that wasn't disclosed in the application. But in that case they'd actually closed that credit card. But it still shows you that the bank had actually gone through the credit card statement or the bank statement and seen a payment, and they're doing that with every deal now. I think with open banking and the Royal Commission, I can't see that going away. And really, I think a lot of people who are looking to borrow or have got lending have really got to think maybe 6-12 months ahead, and start living like on an actual cost of living that's much lower than they are if they want to borrow money. And so it's it'll be a realization for a lot of people when they go to a bank and a bank says, hang on a sec, we're not lending you money because you're spending $7,000 a month.
So actually, that's a really important point. What you're saying is you actually have to get into training, right, before you actually even think about applying for a mortgage.
Yeah.
So that you can compress your living expenses and prove that you can live within a certain set of means.
Yeah, and it's 6 months. It's not 2 weeks or 2 months. It's 6 months, and while it might be compressing it, but you actually have to live on that expenses and prove that you can, rather than before is that you say you want a lower living expense and then hope that you can afford it. I mean, from my point of view as well, is what the bank's minimum repayment is actually a nonsense figure anyway. The bank loves that minimum repayment because it means that you're going to take 30 years to pay off the mortgage, and they're going to make a lot of money off you. And that really should be a pointless figure to you. What you need to be doing is your own figure, and how can I pay this mortgage off a lot faster than 30 years? If you can only just afford the minimum repayment at all-time low interest rates, you're kind of kidding yourself that you can afford it. And so that's something that I go through with clients, is really educate them of what they should be paying if they want to pay off the mortgage in, say, 15 years. That's a real eye-opener. It's it could be 50% more than the actual minimum repayment.
And do you get a sense that often people actually don't know what they're spending, or do most people have a really good feel for what they're actually seeing each month in terms of money in, money out?
It does vary. You've got, another client today, and he was, kind of saying that he knows every single dollar down to the dollar, and he's been, he understands it. But that's quite a rarity. I do think that a lot of people are living month to month. I mean, the banks love that as well. I mean, the cashless society and the way that we're paid and the way that we do pay for things, it does make it very confusing, and very few have actually set up systems in place to actually know what they're spending, what comes in, what goes out. And so it is a very difficult process. What banks are doing, though, because banks know it's difficult to really understand, is they're just taking the shortcut and the easiest option. And the easiest option is just to look at the bank statement, see what you spent for 3 months, look at your last 3 months' credit cards, add them up together, and they say that's your living expenses. Now, that's probably not a fair way of doing it, because you could have gone on a holiday, or you could have had some major expenditure, or fixed the car, or whatever. But unless you can really justify that to the bank won't play ball.
And that is a huge, huge change from even 6 months ago, right? When, you could basically almost get a loan without much disclosure, and then they say, well, providing you fit within the HEM, then everything's fine.
Yeah, and it's not going to go back the other way. So,
Yeah.
this is, and the things that affect the borrowing capacity, is how much money you earn. Okay, well, that's great. How much, sensitivity do they put on the interest rate? And so that's 7.25%. And then what you then do is minus off, repayments on debt. And so, getting rid of all your debt's probably a good thing. Personal loans, credit card loans, and car loans, etc. But then you get stuck at the big one at the bottom, and what's your living expenses? And that's generally speaking, a lot of people are spending a lot more than the minimum living expenses.
There's a surprise, yeah. Well, the other interesting question, and you touched on it in the last conversation that we had, was about negative gearing and the impact of negative gearing, right? And it seems to me that given the fact that possibly Labor is looking more likely to get in at the next election now, we should perhaps take this potential change to negative gearing that they've been talking about more seriously, which, as I understand it, and it's still a bit fluffy around the edges, but is essentially to say we will, at a point in time, only allow new negative gearing on newly built property, not existing property. And we'll also change the capital gains arrangement so that it's less generous in terms of actually the capital gains rules as well. Now, I think you said to me that you felt that was a pretty unfair set of ideas, insofar that it rather separates those that are in the market from those who want to get into the market. But maybe we should explore that a bit further, because I think you and I may have a different view as to the opportunity around and efficacy of negative gearing. Yeah,
so I guess at heart, I am more of a socialist, and I more think about the greater good of people, and that's just who I am as a person. And so, someone who's abusing the system and just taking the system to the nth degree, it doesn't really sit well with me. And I something that really frustrated me with superannuation, if you start searching into Google and figure out how much people have got into super, and how much the big end of town have got in super, it'll scare the hell out of you. You've got 1,500 funds, when I last looked, over $10 million. And so these people had the money basically in pension phase and retirement, and was getting all tax-free growth, tax-free, income. And so it was completely unfair. People who knew about the system maximised it for 25 years to the nth degree. When you could put $1 million in, they put $1 million in. When the kids were 18, they put their max in every year. It's completely unfair. And so they have made changes there, but personally they haven't gone as far as they could. I think it's the same thing with negative gearing, to be honest. I think that, vast 87% of us, roughly, let's say 85% of us just own a home, and 15% of us have, got an investment property. And then the vast majority of those investors have just got one property. And, the stats are always changing, but, let's say 80% of those have just got one property. And so then the 20% have got two. And then when you keep kind of going down, they're the people that we're starting to get problems with, because, they're buying 2, 3, 4, 5, 6, 7, 8, 10 properties. Yep. What's going to slow them down is purely down to borrowing capacity. And so I think that, a lot of those big portfolio investors who have gone out and leveraged and bought, 6, 7, 8, 9, 10 properties, by cutting their borrowing capacity, you're going to create problems for them, especially when interest only rolls off. And so I think that's really smart. And I think, that's going to really limit people just leveraging to the nth degree. And a real focus around credit, should stop them. But then if you look at the other kind of portion of people buying one property, I guess they're just looking, to do something for their future. And when you look at their actual kind of loss every year, that's averaging, $5,000 or $10,000 a year. So, I wouldn't say that they're, manipulating the system and, taking the system for a ride. It's really the big property investors.
So what you're saying is that the better formulation would be to put some limit on the size or the multiples that you can actually gear against, rather than actually saying it's old properties versus new properties.
Yeah, I think I think it'd be hard to do on a number of properties. I think it's be a very hard thing to kind of just say you could have one property, and so then you would just go and try to get the best property, and then you would just fund everyone to the best property. And, it's not really sustainable.
Yeah.
There's places around Australia that really rely on the rental market and investors, and if investors weren't buying them and people weren't buying them, and you'd have all these problems. So I think a number of properties is a bit silly, but I do think that a cap, maybe it's $10,000, and I don't think, even though it'll upset voters, I would personally go retrospective, and I would have it across all voters. And that you can't say that, well, you got in, you get to keep eating the cake, but then all these new guys don't, get it. If you're going to do it, you do it across the board, I believe. It wouldn't win votes, but I think that would be a better solution. I think going new versus old, that's just, because of the second tier, that's just crazy as well. And secondly, uninformed investors don't understand the risks of new investing, and new apartments and new townhouses. And it's the last thing investors should be buying. And once they understand the risks of, potential capital falls and the risks to supply, it's not really going to really encourage people to go invest there anyway. So you'd have to be pretty crazy to invest, even if you get the negative gearing benefits.
We make a great point about buying new properties. I was looking at some data the other day. Through our household surveys, we know where people bought and what they paid versus what's happening now. And the biggest falls for the new property investors who bought in the last year are astonishing, right? I mean, we are talking not just a few percent, we're talking a huge amount in terms of where the property is now. And in many cases, the loan that they've now got is not actually, smaller than the value that they're seeing in the property today, even now. So that's because generally, if you're buying a new place, you're buying top dollar, potentially. And I think you may have said on the previous one, it's a bit like driving a new car away. As soon as you drive it out the showroom, suddenly the value drops. So.
Yeah, I mean, I see people a lot who have come to me and they bought these properties, and for the last 7 years, I've seen 5,000 people, let's say, it probably wouldn't be far off it. And so, and I've looked at all their portfolios and what they've done and when did they buy it and what is it worth and their growth, and it's pretty clear what happens. And the first few years it depreciates, and it depreciates quite fast. And it's not until there's a kind of shortage of supply and wages go up and inflation goes up, and then it starts to sometimes rise, but sometimes it doesn't. If you look at something like in the Docklands in Melbourne, if you bought there 10 years ago, it'd be worth the same. And there's lots of places where supply just keeps coming if there's more demand. And so it's definitely a crazy place to invest.
And the other point that you made earlier on was that maybe grandfathering is actually not the way to deal with this, because you actually are creating effectively two classes of property owners, those who actually still have the ability to be able to offset and new who don't. So that effectively maybe a different formulation would be to change it for everybody. But I guess then Labor's probably steering that political path, knowing that there's quite a few people who'd be pretty annoyed if they suddenly found that those negative gearing opportunities disappeared. So I wonder to what extent it's a political argument rather than actually an economic argument.
Yeah, I mean, everything's political, isn't it? So, I mean, that's probably the answer there. I mean, the biggest thing about negative gearing is that a lot of young people do use it. They can't get into a housing market and they want to live in the inner rings. And the people who are upset the most around housing affordability is a lot of young people. And this is one way for them to, benefit of the property market without being able to buy a house. The other big thing is that if you don't own a home, you're not going to get the capital gains exemption on your home, and so. It really forces people to then go and buy a home, and sometimes it just doesn't suit people because of what they do, and so you can't get home ownership. You're really, sometimes a lot of young people, are calling for negative gearing to go and think it's going to be the magic solution, but what it's sometimes doing is actually creating less opportunity for you to actually get what you want. So I do worry about it. The other side of negative gearing as well is that if you own an asset that's mainly bought by investors, and you own a unit or an apartment in the capital cities, or if the investor market goes, even though you still own your house, you're going to see falls. And so even if you're not a property investor and you just own a little unit in the middle rings of a capital city, if the investors aren't buying them anymore, and homeowners aren't going there to suck up the demand, you are going to see falls as well. So you just got to be, I guess people aren't really aware of that as well.
No, it's certainly complicated. I mean, my analysis shows that the benefits to those who have taken negative gearing on are not equally spread. And I think you made this point earlier on. There's quite a lot of benefits sitting there in the more affluent end of the market, who will have 5, 6, 8, 20 properties. Right, and it's a very long tail, and that long tail then comes down to younger buyers and a whole bunch of broader people. So in a way, you almost need to tease the investment market apart, again, as we were saying earlier on, into different types of markets with different types of people, and so it's hard to see how a single solution can actually optimize for everybody. I think that's part of the complexity. It goes back to our complexity argument from before.
Yeah, and I think that the reason why is, only very few investors have more than 2 properties, and very few have more than 3, etc. A lot of that comes down because a lot of investors haven't made a good decision, and they've bought a house, in the middle of nowhere in Queensland, and they've had it for 10 years. It's done nothing. They haven't made much money in rent. They get a bit over it, and then they just sell it. And that's a very, very common story. They bought it. Because most of them buy apartments, it just doesn't do anything. They lose money, and then they sell, and they never get the returns from property, because they just assume that you can just buy any property, etc. And so we do need, not everyone can own a home. We can have home ownership. It's already at pretty good rates, but if we push that up to 85, 90%, we're still going to need investors to provide housing.
Yeah, that's a good point. And then my last question, what are you seeing? Prices still going down? Is that what the sense of the market is at the moment?
Yeah, 100%. I mean, I was just chatting to a client this morning, they're getting better and better. More and more stocks coming on now. I think a buyer's agent in Melbourne uses this kind of analogy that there's a lot of properties that are becoming stale, and it means they're hitting the market, they're doing an auction campaign, it's not selling, they're leaving it on the market, and that starts to accumulate over time. And so what we're seeing is more stock than ever, and a lot more stock coming. And so and when buyers have got lots of choice, what are you going to do? You're just going to keep waiting, right? Because you're going to be like, well, why do I need to buy now if there's more coming on every week? And the problem just gets worse. And so I definitely think we're going to see problems with supply. And then, that people start sitting on their hands. I think you've just got to be really careful that if you own something in an area where there's already lots of supply, and you're thinking about selling, you've got to be really worried that if things get worse and then you want to sell and there's more supply and prices are lower, sometimes it's better to act sooner rather than later. And so a lot of the kind of high-rise, density units, and where they're kind of building more and more and they're not scarce at all, and investors aren't buying, they're the things you've got to be really worried about.
So from your perspective, not a huge bounce expected in the spring then?
No, and I do think that, every buyer's agent out there, and I speak to lots, over the country, and what they're buying is, really quality assets in established suburbs, on good streets, on nice blocks, north-facing, light, near good schools. They're buying really good stuff. And so the real cream in the suburb, the best streets, the best outlook, they're still selling, they're still going to auction. When the clearance rates are 50%, it's usually those properties that are selling. And they're still, and occasionally they're still getting competed on, because there's always competition out there. The stuff that's really struggling, that isn't even getting listed, it's the busy roads, it's the main roads, it's the dark, things like in the environment, like electricity grids, or just little things that detract on the suburb. Maybe it's housing commission, all these sort of things that these properties just aren't getting a look in. And if you are going to buy, you make sure you get something that's quality. So I think that's the kind of, that gap was very small before, because everyone was just desperate to buy something, but that gap has definitely got bigger and bigger. So maybe this is where you're better off to be buying if you can get a good price, but they're the properties that are also going to keep getting hit the hardest.
So the caveat emptor sounds as though it's still very irrelevant.
Yeah, and I think there's just different markets. I think as well, like, Melbourne and Sydney obviously have had the major boom and they've got major price rises. But Brisbane's a complete different market, and there's parts of Brisbane that are still very competitive, and a client bought there on the weekend, and so it's just much more affordable, and there's a lot of Sydney families moving up there. So, while Sydney and Melbourne might have this really tough period coming up, and I expect it will be, you might find somewhere like Brisbane starts to, do quite well, because it's much more affordable. And even though there are all these changes are happening with lending and things like that, people can still afford it because it hasn't boomed.
What about Hobart and Adelaide? What's going on there? Have you got any sense from your perspective?
Yeah, I mean, if Adelaide had amazing population growth and amazing income growth, and people were moving there for work, you could see that there'd be this real shortage of housing. It's not really the case, and Adelaide's the same thing. It hasn't got a great population growth. People aren't rushing to move there. They can do little things to improve and create jobs and things like that, but it has to happen en masse, because then you have is incomes are going up, and then people start to compete because they want, when their income goes up, they want to buy a property or upgrade. And so while they're good suburbs in Adelaide, are starting to get competition, mainly because low interest rates. The longer that interest rates are lower, more and more buyers kind of enter the market, and then they look at the interest rate and they go, oh, we can afford something at 800. And I do think that's what's happening in good suburbs of Adelaide. People are getting older, they're building a bit more wealth, getting more savings, and then because of low interest rates, they're buying into the good suburbs. But I mean, that starts to run out. When prices hit a certain level, people go, well, actually, no, I don't want to spend more than $750, and so you might have a short-term rise. The real long-term rise will happen if there's income growth and kind of population growth.
Yeah, well, income growth will be nice, but I can't see any way anytime soon for what I'm seeing at the moment.
Yeah, and that's why population growth is so important, because even if incomes aren't going up, then there's more people earning, as a whole, and so that matters. But if income's going up and population isn't going up, it's and bank lending's getting tighter. How does it all stack up?
Yeah, good question. Well, Chris, I really appreciate your time today. It's been a really insightful conversation, so thank you for that. And we should chat back again down the track and see how things are travelling, because I think the next few months are going to be a really interesting ride.
I do agree. Thanks, Martin.
Thanks. If you found this useful, please do like the post and add a comment or question. I read them all. And if you've already subscribed, many thanks, but if you haven't done so, please ring that subscribe bell now. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll talk to you again next time.